Special Focus Fortress Australia, and the rise of the Commodities Empire. The world is trembling before the ghost of recession. America is wobbling, Europe is stagnant, China is slowing down. But in the Southern Hemisphere, a financial fortress still stands tall, even rallying right in the middle of the storm. Australian exports are booming. Is this a lifeline for investment portfolios, or the final dead cat bounce before a global collapse? Welcome to the in-depth Market Navigator today. We are talking about data from October 2025 just released, a number that makes analysts on Wall Street startle and adjust their glasses. Australian goods exports skyrocketed 3.4% in just 1 month. The trade surplus hit the mark of $4,385 million Australian dollars. Why is this figure so important that I must dedicate the entire duration today to dissect it? Because Australia is not just a country. Australia is the anchor of the global raw material economy. When Australia is healthy, it means the world's production machine is still running, despite rumors of recession. Let us go deep into the story of the numbers. Do not let the surface deceive you. This increase of 3.4% does not come from selling luxury items or virtual financial services. It comes from hard commodities. The non-monetary commodity group is leading the game. This shows that real demand for iron ore, coal gas, and strategic metals is still extremely strong. There is a paradox happening that crowds of amateur investors often miss. Media claims that China is dying, that construction demand is dead. If so, who is buying goods from Australia? Who is devouring that iron ore and coal to create a surplus of over 4 billion Australian dollars? The answer is supply chain shifts and new energy demand. The world does not stop consuming resources, they just switch from building houses to building energy and defense infrastructure. And Australia is the arms dealer, literally and figuratively, for this resource war. Look at the Australian dollar, or AUD. In the Forex world, we call it a commodity currency. The recovery of exports is the strongest heart stimulant for this currency. Throughout 2024 and the first half of 2025, the AUD was battered by the strength of the United States dollar, or USD. But the wind is changing. With this huge trade surplus, the Reserve Bank of Australia, or RBA, has an extra layer of protective armor. They do not need to rush to cut interest rates to save the economy, like the Fed or ECB. Their real economy based on exports is still running well. What does this mean for your wallet? Interest rate. Differential and intrinsic strength are supporting the AUD. If you are a Forex investor, shorting the AUD right now is like standing in front of a train rushing towards you. Smart money is starting to long the AUD as a way to hedge against the weakness of the USD. This trade defense line turns Australia into one of the rare safe havens when other G7 economies are struggling with public debt and deficits. But the most fascinating story lies not in currency, it lies in the stock market, specifically the basic resources sector. When exports increase by 3.4%, it means the revenue of mining giants like BHP, Group Rio Tinto, or Fortescue Metals is being pumped up. But be careful, do not buy indiscriminately. You must analyze this growth structure carefully. Data from October shows recovery not just in traditional iron ore. We are seeing the rise of the future-facing metals group, lithium, copper, nickel. These are indispensable materials for the electric vehicle and renewable energy revolution. Australia holds the key to this treasure. Think like a shark. When global inflation remains persistent, paper money loses value. Which assets retain value? Those are things you can touch, taste, or use to build the world. Australian mining stocks right now are not just stocks, they are a call option on inflation and resource scarcity. If you are holding United States technology stocks with sky-high PE ratios, ask yourself. When recession hits, people might stop buying new iPhones, but nations cannot stop buying coal to run power plants, cannot stop buying iron and steel to maintain infrastructure. Australian mining stocks have much more attractive valuations compared to their risks. Free cash flow from these companies is extremely abundant, allowing them to pay high dividends despite market volatility. This is the defense line that today's headline mentioned. However, I am not here to sell you a pink dream. The financial market is a battlefield, not a charity playground. The bright export picture of Australia also hides deadly fatal weaknesses. First, dependence on China. Although Australia is trying to diversify into India and Southeast Asia, China is still the whale swallowing Australian resources. If Beijing suddenly changes import policy or geopolitical tensions, escalate leading to new trade embargoes, that surplus figure of 4 billion could evaporate overnight. This is concentration risk that investors must accept. Second, commodity price volatility. Current export growth is being supported by volume. But if the global economy truly falls into a deep hard landing, demand will drop, dragging commodity prices down. At that time, no matter how many tons of ore Australia digs up, revenue will still plummet. This is the classic bull trap of cyclical stocks. Third, RBA policy. Good economic data is sometimes bad news for the stock market in the short term. Why? Because if exports are too strong and the economy is too hot, the Reserve Bank of Australia will have reason to keep interest rates high for longer, or even increase them to curb imported inflation. This will pressure corporate capital costs and stock valuations. So, what is the combat strategy right now? We do not guess the bottom or the top. We follow the cash flow, rebalancing. If your portfolio is too skewed towards technology or residential real estate, consider rotating a portion of capital into ETFs, tracking Australian resource indices like ASX 200 resources. This is a solid protection layer for your account against the storm of stagflation if it occurs. Stock picking. Do not just look at big caps. Look for mid-caps, mining companies possessing strategic metal mines like lithium or rare earths with low extraction costs. These are potential mergers and acquisitions or M&A targets when giants want to expand scale. Profits from M&A are often huge gap-ups. Observe the AUD-USD pair. This is a leading indicator. If AUD-USD breaks important technical resistance levels, for example the 0.68 to 0.70, mark that as market confirmation that global capital is pouring into Australia. At that time, confidently increase investment proportion in Australian assets. Beware of the liquidity trap. Although exports are up, global liquidity is tightening. Do not use high margin to buy mining stocks right now. Commodity price fluctuations are very large, meaning high volatility. You could be right about the long-term trend, but still burn your account in the short term due to stop-loss sweeps by market makers. Ladies and gentlemen, the Australian trade surplus figure of 4,385 million Australian dollars is not a soulless number. It is the roar of a tiger waking up in the middle of a recession jungle. It confirms a truth. In every circumstance, the world still needs resources to survive and develop. The era of easy money is over. The era of investing in real value and hard assets is taking the throne. Australia stands at the center of that era. But remember, big opportunities always come with big risks. Do not let the euphoria of numbers blind you to geopolitical risks. Invest with a cold head. Treat Australia as a profitable safe haven, not an all-in gamble. The market is never wrong. Only our judgment is wrong. The data has been laid on the table. Australia's healthy exports are strong. The only remaining question is, will you stand outside and watch, or will you join this resource party before it is too late? I am Market Navigator. See you again at the electric board tomorrow, where numbers will decide winners and losers.